Imagine this. You've spent years working hard, saving money for retirement. Now you want to give back, a cause close to your heart, to your church, or a local food pantry. But you're also thinking, I don't want to pay extra taxes if I can avoid it. There's a way to do both. Give generously and pay less in taxes. It's called a Qualified Charitable Distribution, or a QCD. Let's walk through exactly what it is, who can do it, and how it works. Our topic today, Qualified Charitable Distributions, a tax-smart giving strategy. This is a way to send money directly from your retirement account to charity. No detour through your bank account and no tax bill in between. A QCD is when money goes directly from your traditional IRA, that's your retirement savings account, to a qualified charity. When you do it this way, the money doesn't get counted as part of your taxable income. If you're at the age where you must take money out of your IRA each year, called an RMD or required minimum distribution, the QCD can count towards that. Think of it as giving without the tax middleman. The charity gets the full amount you give, and you keep your taxable income lower. If you're 73 or older, you're required to take a certain amount out of your IRA each year. That's your RMD. But here's the catch. RMDs are usually taxed as income. With a QCD, you can satisfy all or part of your RMD and avoid the tax bill. Not everyone can use a QCD. There are a few boxes you need to check first. Age. You must already be 70 and a half or older when the money leaves your account. Account type. The funds have to come from a traditional IRA. Some SEP or simple IRAs can qualify too, but only if no one's making new contributions to them. Charity type. Your gift must go to an IRS-approved 501c3 charity. In other words, an organization the IRS recognizes as eligible to receive tax-deductible donations. Off limits. QCDs can't be used for donor-advised funds or private foundations. There's a ceiling to how much you can give. In 2025, the limit is $108,000 per person, and that amount will go up over time because it's tied to inflation. If you're married, each spouse can give up to the limit from their own IRA. If you give more than that, the extra will be treated like a regular withdrawal and fully taxed. Why would someone choose a QCD? Because it's one of the few ways you can win in two places at once. Financially, you reduce your taxable income, which can lower your Medicare premiums and reduce how much of your Social Security is taxed. Personally, you get to give to a cause you care about without worrying about whether you itemize deductions. For your family, reducing your IRA balance now can lower the tax burden on your heirs later. Here's the big tax perk. Money given through a QCD doesn't show up in your adjusted gross income, AGI. That matters because a lower AGI can help you stay in lower tax bracket, avoid limits on other tax deductions, keep Medicare costs lower, and the charity gets your full gift. No taxes taken out along the way. Making a QCD is pretty straightforward, but you do need to follow these steps carefully. First, check your eligibility. Make sure you're old enough, at least 70 and a half, and that the money will come from the right type of account, a traditional IRA. Second step, choose your charity. Pick the organization you want to support and confirm it's an IRS qualified 501c3. Third step, contact your IRA custodian. Tell them you want to make a qualified charitable distribution. They'll send the money directly from your IRA to the charity. It can't pass through your personal bank account. Fourth step, keep your paperwork. Save the receipts or acknowledgement letter from the charity as proof of your donation. Fifth and final, report it on your taxes. Even though the amount isn't taxable, you still have to list it on your Form 1040 when you file. Follow these steps, and not only will you make the process smooth, but you'll also keep that tax benefit exactly where it belongs, with you. Now, before you rush off to make your QCD, let's talk about a few common trip-ups that can cost you the tax break. They're easy to avoid once you know them. Don't take the money yourself first. The funds have to go directly from your IRA to the charity. If they pass through your personal bank account, the IRS will treat them as a taxable event. Don't give to the wrong kind of organization. The charity must be IRS qualified. No donor advised funds, private foundations, or groups that don't meet the 501c3 status. Don't miss the deadline. The transfer must be completed by December 31st for it to count in that tax year. Don't go over the annual limit. If you give more than the allowed amount, the extra will be taxed like a normal IRA withdrawal. Think of these as guardrails that keep your QCD on track. Stay inside them, and your gift and your tax savings will be safe. Qualified charitable distributions are a way to make your money do double duty, managing your retirement withdrawals and making a difference in the world. You can use them whether or not you itemize deduct. The key is to plan ahead and talk to your financial advisor. With a little strategy, you can write a beautiful chapter in your retirement story, one that takes care of both your finances and the causes that you love.